Voila, there we are at power options. I'm going to take Khokon's question first. He sent me an email earlier, and I think he was registered for today's presentation. Khokon's in a bull put credit spread on DAL. He opened the spread when DAL was around $42 per share. Sold the February 18th 38 put, bought the February 36 strike put, and has a net credit of 23 cents for about a 13% return. Let's take a look at the profit and loss chart. Give ourselves some room here. There we go. So naturally, the stock's now between the strike prices. It fell to 37.86, went down another dollar today. It was about 86 cents out of the money, still above 38 at the opening, but it fell 98 cents during the day. Khokon is considering a concern, and I'm sure many of you have this concern as well. With QQQ approaching or breaking through the SMA 200, he fears that once that's breached, we might see some more significant losses early in the next week, Monday and Tuesday. And Khokon was wondering, would it be best now to buy to close the short put, leave the long put open for further declines, one of the 8 ways we use to manage a bull put credit spread, or is it better to use maybe the pendulum adjustment where we're going to change the bull put credit spread into a bear put debit spread by just moving one option? As with any repair, any management technique on any spread, both carry extra risk and can carry additional losses. Now, I don't know the exact prices that Khokon got for these positions, but what's most important is the net credit is correct based on what he was saying. Let's go ahead and go to view options. We're looking at the February 18th cycle. And what we're going to do is buy to close the short, and this is pretty expensive. We're looking at $1.84. Still have a lot of time value, a lot of time left in the trade, and we're 14, 15 cents in the money right now. What we're just going to simulate doing is buying to close our 38 put for that 184. Did keep a 23-cent net credit. Let's put this just to a normal price, 185. Okay, great. What does this now do? This now gives us a long put. We're just in a long put position, the 36 we originally bought, but it's carrying a cost basis of $1.62 per contract, which means my new break even now drops down to 34.38. Why did I say there's extra risk in this trade? Well, originally on our 2-point spread with 23 cents, the max risk was 177 if the stock fell below 36. Okay, so now if the stock falls below 36, we're going to see less of a loss than that 170. But if the stock stays where it is, or it moves back up in price, we're going to be getting closer and closer to this maximum list of 162 that we paid into the position, especially even if it moves down just a little bit more, but never goes below 36. We need a much bigger movement in order to start seeing the profit on this position. That's the risk of this adjustment on that trade. You have to be really confident in your direction, really confident in the movement of the position you're expecting for this to work. Could it work? Absolutely. If by February 18th, DAL is below $34 or $33, you're in a profit zone instead of taking the maximum loss of 177 on the existing bull put credit spread as it stands. What would the pendulum look like? When I ran it earlier, and I don't know if the prices are going to be about the same. It looks like they're about the same. But when I ran it earlier, it actually was an even flip. I don't think I've ever seen one of those do that before. What do I mean by even flip? His original position has the potential to make 23 cents as long as the stock is trading above $38 at February 18th expiration, 13% return on this position. The pendulum adjustment, we're going to sell to close the 36 put, leave the 38 where it is, and we're going to swing it up here to the 40 strike, thus converting our bull put to a bear put debit with one move. This typically works only when the stock is trading between the strike prices of the position. So let's take a look. What do we have to do? We've got to sell to close our existing 36 put. We're going to get about $1.04. And we're going to buy deeper in the money 40 put for about 305, 306, somewhere in that range. All right, so sell to close the 36. Buy to open the 40. Why the 40? Just keeping the same 2-point spread to keep it simple of where we started with. And I just want to adjust these numbers. Well, this is a buy, so we'll put it at 304. And this is what I meant by it was almost a perfect swing. I usually lose about half of the return. If I was expecting a 20% or 15% return on the credit spread, and I use the pendulum adjustment, the new return usually drops down to 4, 5, or 6%. Profitable as long as the stock continues to be bearish now that it's going against me, and that's a win. But I usually take it down by half. This shows it taking down by half, but there's no monetary requirement here. Okay, that's showing up because it's still reading that I have a bull put credit spread, which is now gone. This is just a bear put debit spread with a cost of 177. And now, just like Pavel's bear put debit spread, as long as DAL, stays below 38, both puts stay in the money, we get the $2 back and make the 23-cent maximum profit, which is still going to be that 13% against the 177 risk. It's exactly the same. What's the risk though? Okay, what if on Monday we're wrong? What if the markets start to fight back, start to come back, and DAL goes up to 38.20 and the next day goes up to 38.50? Now we've got to think about doing the pendulum back again or doing some other adjustment to get back in the bull put credit spread. So now we could lose if the stock starts to move back up as you initially expected. Yes, we're taking a downturn right now. We're taking a little hit on this position. Any type of management on a credit or a debit spread, even though we teach the 8 ways to manage a credit or a debit spread, does carry the risk if the stock reverses. It's not a fail-safe. Not every position can be repaired. I just wanted to show Khokon the 2 examples here of what they'd look like graphically, that this is interesting to me, as a pendulum adjustment because it kept the same return as the original spread, and it's just something I've never come across before. If DAL continues to go down, I think this is a good trade. The risk with the other one is, yes, you have a long 36 put now, but at a cost of 162, so the break even was down in that $34 range. You need a much bigger movement for this to start to get into the profit level. Could it happen? Could we go down another 8, 9, 10% down to $34 or $33? Possibly. Probably. It could happen. I'm not saying it's going to. It could happen. But that's why I prefer some of these, is just because it's one adjustment where if it continues down, I don't have to worry about it. I've kept a really good break even, right? We're already below the break even price converting to this debit spread with a pendulum adjustment. And I like that too. That's a really good aspect of this trade, adjustment to the additional bull put. Whereas you need a much bigger move and you have a much lower break even by just buying to close the short and leaving the long position open in that case. So those are just my thoughts on your 2 approaches to manage this particular DAL bull put Khokon. Just wanted to get some of the visuals in there so you could see that as well.